here we're looking at deductions. And the best place to start by looking at deductions is to jump back to this concept of assessable income. That's the gross amount that a taxpayer derives in a tax period. Whereas taxable income, that's the amount that a person's going to be taxed on after you go and take and apply the tax scales and other bits and pieces. This taxable income is assessable income less allowable deductions. And so everything we're going to look at in terms of deductions is the amount that a taxpayer is using to reduce their assessable income down to determine their taxable income for a particular period. And deductions, which are creatures of statute, come in two flavors. This recording is entirely devoted to the first type, which is known as general deductions. They are located in 8-1 of the Income Tax Act 1997, the new Tax Act. Whereas specific deductions, which are things that Parliament has intentionally gone through and mapped out to make allowable, are in a separate recording. They are stored in 8-5 of the Tax Act. And in broad terms, general deductions, you as a taxpayer can claim them if you can prove one of two things, which are in 8-1 subsection 1, either that the amount was incurred in gaining or deriving your taxable income, that's the direct limb, or that the amount was incurred in necessarily as a part of carrying on a business. That's what's known as the second limb. Now, you need to prove one of those, and they are necessary but not sufficient, because if any of what we call the negative limbs, any of these 4 points are satisfied, then the taxpayer cannot claim that particular amount. And those 4 things are whether the particular expenditure is capital in nature. The second is whether it's private or domestic in nature. The third is whether it was incurred in deriving either exempt income or non-assessable non-exempt income. And the fourth is where somewhere in the tax law, that particular type of expenditure is expressly disallowed. That taxpayer is not allowed to claim that particular amount as a general deduction. So we will go through each of these in more detail. Before delving too far into this, it's probably worth just spending a little bit of time talking about the naming system, which is the nomenclature that we use in regards to tax deductions. Now, the two places where deductions are stored, which is 8-1, that's known as the general deductions provision, and the other is 8-5, which is the specific deduction section. And each of those two have their own particular rules. And for the purposes of this recording, though, the rules for general deductions in 8-1 are mapped around a series of what we call limbs. Now, this particular legal term limbs is different and distinct from another legal term we use called elements. And both elements and limbs are points of law or particular facts that a person or an entity needs to prove in order to succeed in some legal point, so to speak. So with elements, each of those points needs to be proved conjunctively. That is, you would need to prove all of them. With limbs, they need to be proved disjunctively. That is, if you can prove one of those points, then you succeed in that particular action or to prove that particular point. And so here, when we use the phrase limbs, we talk about the 2 positive limbs and the 4 negative limbs. That is, if a taxpayer can prove either of the first 2 limbs, that's necessary, but it's not sufficient in order to gain a deduction under the general deductions provision. Because ultimately, proving that either an amount was incurred in deriving assessable income or necessarily incurred in the carrying on of a business, again, for the purposes of deriving income, you need to prove one of those. So it's necessary to do that. But that's not going to be sufficient on its own, because if one of the 4 negative limbs is proved, then you won't get the deduction. That is, if, I guess, arguably the commissioner, even though ultimately it's you as the taxpayer, would have to prove them essentially to the negative. If one of those 4 things is true, you won't get the deduction. So they are whether the particular amount claimed is capital in nature, whether it's private or domestic in nature, whether it's incurred in the deriving of exempt or non-assessable, non-exempt income, or whether it's been specifically disallowed somewhere in the tax law. And so, again, proving one of the limbs is a requirement, one of the positive limbs, but if any of the negative limbs are satisfied, the taxpayer will not get a deduction for a particular amount, a loss or outgoing. One of the things that's a requirement for both of the 2 positive limbs in 8-1 is that there is some form of loss or outgoing to the taxpayer. And this idea of loss or outgoing is actually much broader than merely spending money for a particular expense. An example of that is in Charles Moore and Company and the Commissioner of Taxation. In that particular case, a department store, the employees were robbed as they were wandering to the bank in order to deposit the weekly takings. There, perhaps unkindly, the commissioner actually disallowed the department store this deduction for the amount that was lost. And the High Court quite strongly disagreed with that characterization. There they said that, look, ultimately this isn't an expense, but it was still some form of loss or outgoing to the taxpayer in that case, even if it wasn't a deliberate, willful act of paying some sum of money. And the courts, in regards to this particular aspect of general deductions, are quite lenient in regards to the idea of a loss or an outgoing. It uses really an ordinary meaning or definition of that particular phrase. One other phrase which applies to both aspects of the 2 limbs of general deductibility is the idea of apportionment. That is, the section says that the losses or outgoings can be claimed only to the extent that they've been incurred. What that really means is that if some amount was incurred either for the gaining of assessable income or necessarily incurred in the carrying on of a business for the ultimate purpose of gaining income, then the fraction which was put towards some other purpose can't be a deduction under the general provisions. And so an example of this would be where an entity, for example, has, say, internet, partially which is available for the business users and partially which is available for private use. The idea is that under the general deduction provisions, that the taxpayer must demonstrate the fraction which is used towards either deriving assessable income directly under the first limb or that's necessarily incurred in carrying on a business under the second limb. And so this idea of apportioning those expenses into that which can be claimed as a deduction and those which are essentially private in nature can be determined and recorded. One of the, I guess, kind of neat features of our tax system is the idea that when you're going about structuring your affairs to derive income, the tax office just doesn't care how you go about doing that. It's really none of their business. You, as the taxpayer, can go and spend money to either derive assessable income or necessarily incur expenses as part of carrying on a business. And ultimately, how you go about doing that is completely up to you. However, there are some limits to that. So under the general deduction provisions, the commissioner can disallow some or potentially all of a deduction if it is either grossly excessive, if it is a mix of purposes, and again, this ties back to that, to the extent of phrase, or in a situation where it's been incurred to specifically to obtain some form of tax benefit. And ultimately, if the commissioner does really raise a query in regards to that, the onus is actually back on the taxpayer to go through and demonstrate that it's not one of those things. But ultimately, that happens quite rarely. And I think it's really important for students of tax law to appreciate at this point that the way our tax system operates in regards to general deductions gives a lot of flexibility to taxpayers to go about structuring their affairs really as they wish. One of the consequences of how 8-1 is structured is to do with the first two limbs, because the first limb of 8-1 can be used by any taxpayer. That is, if a taxpayer is incurring some form of loss or outgoing when they're going through and gaining or producing their assessable income, they can get a tax deduction. It doesn't really matter what kind of taxpayer you are. That, in many ways, is the direct mechanism of getting a deduction. And that's available to any taxpayer. The second one, though, these amounts that are necessarily incurred in the carrying on of a business, by very definition, can only be claimed by taxpayers who are carrying on a business. So having some sort of commercial aim or purpose is going to be necessary but not sufficient. You have to meet that test of carrying on a business in order to deduct things under the second limb. So an example of that would be a taxpayer who buys and sells things. If you say, for example, buy things on the internet and then you sell them again. Now, in theory, if you are doing this with the idea of making a profit, it's not going to be a hobby. And so, as such, you are going to have to be assessed on those amounts so that you will buy things and you'll sell them. The amount you sell them for is going to be income. The amount that you buy them for is going to be able to be deducted under the first limb of 8-1. However, merely having this commercial aim in this particular endeavor isn't going to be sufficient to be carrying on a business. You have to meet the remainder of those factors for carrying on, that having the size, scale, intention to carry on business, having continuity, having systems in place. Only then are you going to be able to claim things that are necessarily incurred in that process. So in the case of you sitting at home buying and selling things on the internet, that may be, for example, the fraction of your internet expenses that you are necessarily incurring as part of running that business, or perhaps your a fraction of your rent as part of incurring that particular business. Now, some of these are also covered under the specific deduction provisions, but it's important to note that things that are incidental to this process can't be claimed under 8-1 unless you're carrying on a business, because they only apply or fall under that second limb and they don't apply to the first limb. The first limb is for where income and expenditure has some form of direct connection in regards to those two things. Now, what the courts say in regards to both limbs of 8-1 are that there has to be some form of logical and factual connection between the particular amount of that's expended be it a loss or an outgoing, and it being either incurred under the first limb with the relevant income earning activity, or necessarily incurred with the business in regards to that second limb. And there are some tests that the courts have used to explain this in a little more depth. Now, usually this nexus to the earning activity is straightforward and commonsensical. However, in situations where things are a little bit more borderline, the courts have developed 4 tests that they use, and technically all 4 of these have to be present or have to be demonstrated in regards to a particular item that's where it's ambiguous as to whether it has this necessary connection to the relevant activity. And those tests are the incident and relevant test, the essential character test, the purpose test, and the occasion of the expenditure test. We'll go through each in turn. The incident and relevant test is really just to ensure that there is some logical connection to the particular expenditure, the loss or outlay, and either the income producing activities or the business activities of the taxpayer. The difficult situations that have arisen, particularly in the past, that the courts have wrangled with, are whether or not those particular activities actually produce income themselves. And really the definitive answer is no, they don't have to. And so in Herald and Weekly Times, the commissioner tried to argue that the newspaper paying out legal fees for defamation didn't actually produce anything, therefore ought not to be a deduction. And the High Court disagreed. And they said that provided there is some logical series of steps where you can see this connection, that's going to be fine. The court also said in Charles Moore and Co., there in that situation, the clerk taking the weekly takings to the bank got robbed. And there they said that, look, there would still be a logical connection, even if the clerk, for example, had stopped at a cafe on the way home. It might be quite different if the loss had come from the clerk stopping on the way to home and going to, say, the casino and losing all of the money. That might not have had the same sort of logical connection. But ultimately, it's a pretty low bar. You just need to be able to connect a series of dots in order to see at some stage in the future that there is or may be some form of income flowing from the activity. The second test that the courts use is what's called the essential character test. Here, it just looks at the fundamental nature of the particular expenditure to determine whether or not it either is income producing or relates to the carrying on of a business. And if it doesn't have that essential characteristic, it can't be a deduction under the general rules. We'll note also that the courts have developed this really in the context of looking at private or personal expenditures, and Parliament sort of jumped in and created the second general limb, a second negative limb of the general deductions. And so this essential character test, it's kind of subordinate to that. So it would be a rare situation where a particular type of expenditure would pass the essential character test and then need to be knocked out by the second limb. And so ultimately, the types of situations the courts have looked at in regards to these cases really predate the contemporary structure of 8-1. Note that there are certain types of expenditures that the courts say are private or personal, but often the reasoning behind this, when they talk about the essential character, is that in situations where a person has some form of outlay, doing some form of education or doing some form of preliminary activities, eating more food in the case of FCT and Cooper, for example, to be a professional sports person, what they say is that in that situation, the essential character, not only is it private, it's also preliminary, in that you are spending or outlaying money in order to bring yourself into a position in order to derive income. Similarly with travel to and from one's residence, there it's not the activity itself that's leading to the deriving of income. It's preliminary to that process. So ultimately, it's two sides of the same coin, this essential character test and the second negative limb. But ultimately, it's important to know from this point that the amounts that are expended, if they relate to something that people ordinarily do in their lives, it's unlikely that that will have this necessary character of being able to be a general deduction. Third test that the courts use to determine whether or not a particular outgoing has a nexus to either an income earning activity or carrying on a business is actually the intent of the taxpayer themselves. So in most areas of law, we use a reasonable person test, an objective test. What would a reasonable person have done in this particular set of circumstances? However, in some situations, and this being one of them, the courts actually look at the subjective intention, so the mind of the actual taxpayer themselves, when looking at what they are actually intending with the particular outlay. Was it truly to derive some form of income, or is it necessarily incurred in the carrying on of a business, or instead was it fundamentally for another purpose? And in usually in most situations, that purpose is to minimize tax liability. And that's what happened with Uri and the commissioner. There, Mr. Uri had some loans, but he had them to family members. And ultimately, the courts say that in that sort of situation, where you've created these sort of artificial schemes, it's not going to have this requisite purpose in order to satisfy the nexus test under this third test. The final test that the courts use is what's called the occasion of the expenditure test. Now, this is looking at each particular item of expenditure and examining its logical connection to the relevant income producing activity or the carrying on of a business. Now, it's important to note here that this is similar, but not fundamentally based in the time. Now, the reason that I say that is that income itself can be derived at a later period of time. So your income that may be logically connected may come at a later period of time, or the profit from a business may come at a later period of time. That's fine. The courts accept that. However, the courts must be able to see when the particular amount is expended that at that particular point of time has a logical connection. So a series of dots that would lead either to directly producing income or to some profit being obtained in the medium to long term. One thing to note that as an example, the courts have examined situations where legal expenses have been paid for by an employee. Now, in those sort of situations where you've got a criminal matter, for example, this outlay is going to impact potentially the person's current role, but it's certainly in regards to defending oneself in the criminal sense and finding oneself not guilty of criminal offences is going to impact future roles the person would have. And there they said that, look, in regards to future roles, the occasion test might not be satisfied, but it will be in regards to the current role. So if the income generation in your current role as an employee is going to be impacted, then legal expenses or the cost incurred in defending against such matters will meet this occasion of the expenditure test. Turning now to additional rules. This one is specifically to do with the second limb, that is, to do with the carrying on of a business. Now, in order to obtain a deduction under the general provisions, a particular outgoing has to be necessarily incurred in regards to that business. And to be honest, the courts have been pretty generous in regards to interpreting this. Ultimately, it's not for the courts to tell taxpayers how to organize their business affairs. That would be illogical and certainly very efficient. And thus, in situations where you may be advising clients in regards to this, provided, as previously mentioned, it's not something which is grossly excessive, it's going to be very likely the taxpayer is going to be able to argue that amounts have this aspect of being necessarily incurred in regards to a business. Ultimately, they can be bad business decisions. If you want to fly first class to a meeting in Azerbaijan, that's your choice. It's your business. Now, the courts have looked at this particular phrase in regards to legal expenses, and there they have, again, been quite generous in regards to employees, for example, defending against particular matters. And not only have they been generous in terms of allowing these things, that they've actually extended to things like directors and agents as well. And so that is, in addition to this, the courts have been happy to rule that these things aren't capital in nature. So even where you're defending the underlying sort of business structure or the agents or employees on that, it's quite a low bar to demonstrate that these things have been necessarily incurred in the running of the business and arguably aren't to be capitalized and written off over a longer period of time. One thing that the courts have quite consistently stated is that a particular loss or outgoing that is incurred before the relevant activities start, be they the income producing activities under the first positive limb or the business under the second positive limb, if those activities haven't started, you won't be able to get a deduction for them, at least under the general provisions. And that's because the amounts that are incurred have been incurred as a preliminary step towards subsequently going and establishing a business or deriving income. So the courts have been quite firm on that particular point. Now, the reverse is not true though. So expenditure that's incurred after a particular income earning activity or business ceases, in many situations can still be claimed as a deduction. And the reasoning behind that is that the particular liability, even though not accounted for at the time the income was being produced or the business was being carried on, nonetheless still has this logical necessary connection. And thus, after the business ceases or after the income ceases to be produced, it is still possible to claim a deduction. Again, provided that it still has this necessary logical connection to the original activities. Turning now to the negative limbs of the general deduction provisions. These essentially operate to disallow something. So assuming that you satisfy one or sometimes both of the two positive limbs, that's necessary, but it's not sufficient to gain a deduction under the general deduction provisions. All of the negative limbs have to be answered in the negative. That is, the deduction will be disallowed if the particular outgoing or loss is capital in nature, is private or domestic in nature, is incurred in deriving exempt or non-assessable, non-exempt income, or if there is a specific provision somewhere in the tax legislation that says that particular type of deduction is disallowed. So if any of those points are true, if any of those tests are satisfied, the particular deduction will be disallowed. So the first of these four negative limbs are to do with, essentially capital transactions. So under the first of the four negative limbs, outgoings of a capital nature, can't be general deductions. Now, it's probably worth noting from the outset that almost all such capital expenditure ultimately can be deducted under one or more of the specific deduction provisions. Usually, though, those are deducted over a period of time. They're not a deduction just in the current period. And there's a series of court cases that the courts use for determining whether or not a particular item of expenditure is capital in nature or not. And so the tests sort of evolved over the last 100 years or so. And so the three they use is the once and for all test, the enduring benefits test, and the business entity test. But the third one is really the preferred test in Australia, and it sort of folds the previous two tests into it. So I'll go through each of these in turn. The once and for all test to determine whether or not a particular expenditure is capital or revenue in nature is simply to look at whether or not this amount is essentially a final amount. So that idea of a particular outgoing is going to happen once and not happen again, at least in regards to the same subject matter. As you can imagine, this is fraught with some practical difficulties because it's quite difficult to predict the future. It's hard to judge whether or not an amount is going to be forever or not. And so this aspect of guesswork means that while it's a useful place to start, it's not going to be determinative in onto itself. The second test the courts use is the enduring benefits test. So there the court looks at a particular amount that's been outlaid and basically analyzes it to work out whether there's a continuous ongoing benefit to the particular taxpayer. And arguably this is an actuarial exercise. However, like a lot of actuarial exercises, it does require a fair amount of guesswork. And one of the challenges there is that really goes back to the taxpayer themselves to try and work out subjectively what that benefit's going to be. And so as a result, it can be a little bit difficult, again, to use this test definitively to determine whether a particular item is capital or not. Ultimately, though, it is a useful tool for the courts to use for being able to categorize things one way or another, at least in the preliminary stages. Now, the third test is what's known as the business entity test. And this sort of folds the previous two tests into it. And the courts here look at the underlying structure of the relevant business for determining whether or not an item is capital or not. And they have said that, look, if the particular expenditure relates to the process, the day-to-day operation of the business, that's going to be essentially a revenue. It's not going to be capital in nature. And as such, you would be able to claim it under the general deduction provisions. However, if it relates to the underlying structure, profit yielding structure of the business itself, it's much more likely that it'll be considered to be capital. Similar to the analogy the courts use for income in regards to the tree and the fruit of that tree. Now, while this is the preferred test for determining whether a particular item of expenditure is capital or revenue in nature or able to be deducted, it really only works for business taxpayers. It doesn't work quite as well for taxpayers who aren't carrying on a business. In other words, trying to claim a deduction under the first limb. Looking now at the second negative limb of 8-1, deduction will be disallowed if it is private or domestic in nature. This test is very similar to the essential character nexus test, but it's explicitly mapped out in the section itself. And so the cases that the courts use the essential character nexus test and look at this second negative limb are functionally the same thing. In most situations, you would have to somehow have passed the essential character nexus test in order to then have to go and examine the second negative limb. So functionally, the areas or types of transactions that the courts look at and that they've determined to be private or domestic in nature are travel or travel expenses, where one of the ends of the particular travel is home, a residence. Another thing they look at is relocation costs. That's where an employee is moving, because ultimately the courts have said that that process of moving, the expense to move, it is essentially a preliminary series of steps that a person takes that's ultimately private or domestic in nature, to then put themselves in a position where they can go about deriving income from employment. Childcare, similarly, is a fundamentally personal matter. Food and drink, clothing, and housing are the other areas. And taxpayers do try. They do try these things on. They do try to make these sorts of claims. And from time to time, they can have stronger arguments than in the past. And those do go before the courts. But fundamentally, the rules are quite simple and straightforward. The courts set a very high bar for determining whether a particular item, which by its nature is private or domestic, can be deducted. And in these sort of situations, Parliament intervenes to really map out, to make things expressly clear that certain things can or can't be deductions. Those things, though, fall under the specific, not the general deduction provisions. The third negative limb is concerned with expenditure, losses, outgoings that are incurred in producing or deriving non-assessable, non-exempt, or exempt income. Now, that can also relate to the second positive limb as well, which is the idea of carrying on a business, again, with a view to derive at some stage exempt or non-assessable, non-exempt income. Ultimately, though, there's some argument that this negative limb probably doesn't even need to exist. Why? Because it's a requirement under the positive limbs that you're deriving income. And by definition, that's not deriving exempt or non-assessable, non-exempt income. Nonetheless, there have been cases that have gone before the court, and the courts have been required to look at these particular situations. And the challenge really comes from the different types of transactions, particularly government payments, because sometimes it's not clear whether a particular payment that's been made to a taxpayer, how the tax treatment is for that. So there's a little bit of confusion about those particular types of transactions. There's difference between exempt income, non-assessable, non-exempt income, taxable and rebatable government payments, and items that aren't assessable income and are not reportable assessable income. I'll go through each of these in turn and give some examples of each. Starting first with exempt income, there are certain types of allowances and pensions that are simply exempt. So if a particular person receives that form of income, expenditure that's gone towards deriving that income can't be claimed as a general deduction. Similarly, for Australian Defence Force or Australian Federal Police Force personnel serving overseas and being paid by the Commonwealth, or for recipients of bursaries, scholarships, and grants, be they from private entities or from the Commonwealth. So these examples are exempt income. Another is where a person receives compensation. There's a statutory rule that compensation for personal injury is neither capital nor income in nature. It is deemed to be exempt income. So the distinction between exempt income and non-assessable non-exempt income is that non-assessable non-exempt income doesn't impact or affect any things like carried forward losses. There are situations where, because for both of these types of income, you have to report them in your tax return, but in many situations, they're functionally the same. There are, however, some situations where, again, in terms of carried forward losses in other areas, where income figures are calculated that non-assessable, non-exempt income, in inverted commas, is better, so to speak. Now, some examples of non-assessable, non-exempt income are where you receive an employment termination payment, an ETP, a redundancy payment, or if your employer contributes towards your superannuation. Those are all non-assessable, non-exempt forms of income. Now, the next category of income that we're going to just look at are what we call taxable government payments. These are income, but the way that they're structured, a person who's the recipient of these forms of income also receives a rebate, which is a tax offset, so that functionally they're not paying tax on those particular amounts. So the key thing to note that under the general law rules, if you are incurring expenditure in order to derive this form of income, by default, you can claim that as a deduction. Now, there are some exceptions to that, which is to do with government payments where you get this form of rebate. So some of these you're allowed this rebate, some of them you're not. So for most government payments of this ilk, they have the rebate, and you will be specifically denied a deduction in regards to those, which we'll get to at a later stage. But some examples here of these taxable government payments are the AB study, the age pension, OSS study for students, carer payments, job seeker payments for the unemployed, parenting payments, youth allowance, and other forms of special ad hoc benefits. Now, this final category of transactions, which again seems to draw some aspects of confusion about it, are non-taxable and non-reportable. So unlike the categories of exempt income and non-assessable, non-exempt income, you neither pay tax on these things nor do you report them in your tax return. So mere gifts, the gifts that a person receives without obtaining them for some form of reward, those don't go in your tax return. Neither do windfall gains. So one-off unexpected gains for things like lotteries, for example, and child support payments. So the idea is that with child support and spouse maintenance, payments that are structured under certain statutory arrangements, systems and schemes, those payments are kind of essentially mutual payments between parents, for example, in terms of recoupment, in terms of the cost of raising children. The Child Support Agency, or CSA, you are not required to put those amounts into your tax return. So they're neither exempt nor non-exempt, not accessible, non-exempt income. They're not government payments, and they don't go in your tax return. Going to turn now to the specific denial provisions. So this is really under the fourth negative limb, so to speak, but each of these is mapped out in the tax legislation in either the new or the old Tax Act, because there are specific types of activities that Parliament does not want people to be able to claim under the general deduction provisions. And it's a long list, and really each of them has a particular policy objective that it's trying to achieve. And thus, I'll go through and talk about each of these in turn. So the first area of specific denial provisions are penalties. And we've all been tempted from time to time when receiving some form of penalty, be it from the federal or the state or from local government bodies, or sometimes private bodies such as libraries or incorporated associations that we're a part of. No one likes paying a fine, and the policymakers in the federal government have said for quite a long time that ultimately you are paying these fines as a punishment and as a deterrent to others. So it has those two qualities of this, what we call quasi-criminal law in regards to regulatory offences. And Parliament also said that it wouldn't be fair if, for example, high income earning people, in terms of paying fine, often high income earning people, there's a correlation with them also being wealthier as well, having more disposable income to pay fines. It would be almost a travesty if a person who is on a high margin rate would get the most tax benefit from obtaining a deduction from those. So as such, they're simply prohibited. You can't get a tax deduction from a fine. So if you get, for example, a speeding fine by being pulled over by a police officer, or driving through past a stationary camera, or parking tickets that you obtain from the local council, they can't be deducted. Now, this is different, though, to penalties that come from private bodies. So, for example, if you were to borrow a book hypothetically from the James Cook University Library and you used, I don't know, hypothetically your student card instead of your staff card, and hypothetically got a $355 fine, and if that said university wouldn't let that fine go and you had to pay $355 in order to graduate, you would be able to claim that as a tax action. Or in that situation, it would go towards self-education expenses. But the key thing to note is that even where you have bodies that are run by local councils, a fine from the library will not fall under the preclusion. So you are allowed to deduct those. Whereas a fine from a council officer in the form of, say, a parking warden, where there is a specific offence, you wouldn't be able to deduct that. So that's really the distinction you need to be aware of in regards to trying to obtain deductions under the general provisions where there's some form of monetary penalty. Now, as a statutory rule, if you are an employer and you have employees, those employees will, under the statutory provisions, accrue annual leave. That could be long service leave, bereavement leave, sick leave, and any other form of leave that they're entitled to, both under the provisions of the Fair Work Act and any relevant industry award or any enterprise agreement for large organizations, as well as any specific types of leave they also get under their particular contract. Now, one thing about leave is that it replaces income, so to speak, so that the idea is that the employer carries on paying the employee the same amount for their wage or salary when they are away or not working for a particular period. And as a statutory rule, you cannot claim a deduction until that leave is taken. That's just a rule. For policy reasons, you can't guess, you can't create provisions, you can't do it ahead of time. Now, we know, putting our accounting hats on, that we have to account for this, particularly when you have employees that accrue a lot of leave. But in practical terms, the Parliament's jumped in and said you have to deduct it, or you can't deduct it until they actually take the leave, or when their employment finishes and it needs to be cashed out in some way, either through termination or through death. With many of those government assistance payments, they receive a sort of a concessional tax method, in that it's actually ordinary income. So it's just ordinarily considered to be income, ordinary concepts, and it's just added to your the amount of income that you earn in a particular year. And the idea is that in regards to those amounts, they also receive a rebate. And so that those government assistance payments are known as a rebatable benefit. And that's defined in the old Tax Act in section 160, capital A, capital A, capital A. Now, under the fourth negative limb in the general deduction provisions, if you are a recipient of a rebatable benefit, that amounts that you incur in regards to deriving that cannot be deducted. It's specifically disallowed. And an example of this came up a few years ago now in the Anstis case, where a student was the recipient of certain government payments in regards to education. And she argued that expenditure that was derived or incurred in regards to deriving that particular income ought to be deductible. And she went to the High Court, she actually won, and thus 26-19 was put in to make it expressly clear that you cannot get deductions when you are the recipient of these government payments. You can't double dip, so to speak, in regards to these amounts. Here are some rules that if you're a student, you probably don't want to hear. And the reason for that is that everything to do with your student loans, your fee help or HECS, is not a tax deduction. Now, this includes the incurring of the debt when you take out the loan, when you start studying, the repayment of the debt when you earn beyond the threshold amount, sort of $45,000, $49,000 per annum, or you voluntarily pay it back, or when it is indexed. So when an interest amount is added to it to compound to that debt. So all three of those particular phenomenon, you cannot get a tax deduction. So it's actually an important starting point in strategy and tax planning, because for taxpayers on high marginal rates, it may well be appropriate to pay cash for your university studies as a result, if you can claim some form of tax benefit, assuming that under the self-education deduction rules that we'll cover at a later stage, you are able to claim that as a tax deduction. For students on very low marginal rates, it may be something of a moot point, but it's really important to know, because ultimately when people are out in the world with career type jobs that start to pay more and more money and they're looking to do additional education, it is an important thing for them to know when making the strategic decision to pay out of their own pocket or to put it on HECS. Another area where particular types of expenditure is expressly disallowed is in regards to political donations. So businesses can't claim a deduction at all for making donations to political parties or to individual candidates. That's not to say they can't do it. They're allowed to do it. They just can't get a tax deduction for doing it. 26-22 forbids that. However, individuals who derive their income as employees, so if you're getting employment income in the form of salary or wages, you can make donations of up to $1,500, and you can include those as a specific deduction. Now, it's not uncommon for people to go on work-related trips, and you can do this as an employee, so your employer usually pays for said trip, or you may be self-employed. You may have your own business and maybe your own entity or a closely held entity that pays for that. And the tax office, in a lot of ways, and the federal government aren't silly. We're very much aware that people go and take their partners with them, or their kids. And as such, if you take a relative, it is expressly disallowed that you can claim their portion as a tax deduction. You simply can't. So you have to carefully go through and map out which is the stuff allocated to the person on the work-related trip and which is allocated to the partner. Now, there is an exception to that, and that is if the taxpayer can prove both that the family member is either also an employee of the same employer, or they're employed by that particular taxpayer. And importantly, it has to be such that it's reasonable to conclude that that particular person would have gone anyway. So their position in the organization or in regards to that taxpayer as an employee is one where they would have gone on that particular trip even if there wasn't that family relationship. So that in those situations, if there is some form of arm's length transaction or wages or such like in regards to the partner, those situations, it's an exception to the rule in 26-30, and you can claim a tax deduction in regards to that person. Sometimes tax rules are established right from the outset. The tax code gets written and the fundamental rules are in there. Sometimes, though, the tax office identifies particular problems that were unforeseen by Parliament. One of those was people that owned rental properties who were claiming travel driving between their various rental properties. And fundamentally, Parliament considered that to be unfair. And so they didn't expressly deny such a deduction. And the reasoning behind that is that if you're in the business of doing a particular activity, again, residential property management, for example, in that case, then that would be fine. However, income from property, rental income from residential property, is really considered to be a passive income stream. And so it gave, so the Parliament believes that those taxpayers an additional benefit that that they kind of deemed was somewhat unjust. And so as such, if you do have residential property, you're expressly disallowed from claiming a deduction when driving between those properties. And this is different, that we'll note at a later stage, when a person is driving between two workplaces or two places of business. That's quite a different proposition. And in those situations, you will be allowed a deduction. It's quite common in this life for people to hire relatives to do particular tasks for them and to remunerate those relatives. This is an ordinary, common event. However, it would be quite trivially easy to be able to manipulate this so as to obtain quite unfair tax benefits as a result, by simply paying your relative more than what the market rate for their services is. So as such, the payments to related entities rules expressly disallow the excess, so that if you are paying a related person or relative, or to a partnership where your relatives is one of the partners, you can only claim so much is as reasonable in regards to those payments. So you can pay whatever you like, but you can only get as a tax deduction a reasonable amount. And there's a statutory definition of relative in 995-1, and that includes your spouse. It also includes your parents, grandparents, brothers, sisters, aunts, uncles, nephews, nieces, and any of their spouses. And so as such, if you have things that are a bit more broad, that's going to be fine. Your cousin, for example. Now, in regards to this reasonable amount, the courts just look at market values. They look at award amounts. So that in situations where you're paying somebody to do a particular service for you and that you're related to them, an appropriate mechanism, if you do want to obtain the full tax benefit, is to pay the award amount. That's the industry negotiated wage for that particular service. If you happen to be a member of some form of social club and you pay membership fees to be in that social club, and that club is fundamentally to do with recreation or entertainment, those fees are not able to be claimed as tax deductions. So the idea is that that's fundamentally, that's kind of a personal thing. It's also subject to manipulation by taxpayers coming together to obtain some form of benefit. Now, there's an exception to that, and those are airport lounge clubs. So the Parliament sufficiently happy, so to speak, that they are business related enough to not really need to fall within the scope of this. And so the tax office and parliament have said that if you're signed up to be, say, a Qantas Club member, that will not fall within the scope of 26-45, and you will be able to claim that as a tax deduction. From some of our earlier recordings, you may be aware of the La Rosa case. There, a heroin dealer tried to claim a deduction of $200,000 for a heroin deal that went poorly. And ultimately, he won. And as such, Parliament intervened and they said, look, losses are outgoings that flow from a conviction for an indictable offence. Okay, you've got to satisfy those two things. And if you do, it's not a tax deduction. So that if you're convicted for an indictable offence, the activities that particular deduction relate to, you retrospectively are going to have your assessment amended. Probably. It's up to the tax office to go through and to amend your tax assessment. And they've only got 4 years after the date that the conviction is recorded to do so. Also note that the underlying purpose of this wasn't to preclude people carrying on lawful businesses who may, for whatever reason, end up being convicted of an indictable offence. That wasn't really the purpose of it. It was really designed to fundamentally thwart people whose entire business model was based around criminal activities. And so the explanatory memorandum is quite clear in stating that where a taxpayer has a lawful business, it's only the activities that relate to the indictable offence itself, not all of the activities of that particular business that are going to be disallowed. One quite important denial of a deduction comes from GST input tax credits. I won't delve too much into the GST system, but suffice to say, a GST registered taxpayer, when they purchase something, say you purchase an item for $1,000, you must pay an additional $100 in GST, so that you would, out of your bank account, pay $1,100. The particular thing that you're purchasing still costs only $1,000, and the additional 100 is what's called an input tax credit. And ultimately, at the end of each GST reporting period, you can claim a refund for that amount. And so as such, it's not really an outgoing, so to speak. And to make this abundantly clear, 27-5 expressly says that the amount that you expend in regards to input tax credits is not a deduction. It is basically going to pass through your system. It is an amount that you have to pay, but you're going to get it back at some later stage, or at least it'll reduce the amount of GST liability you'll have for a particular period. Note that for taxpayers who aren't GST registered, there's no such thing as input tax credits. You're just paying the full amount. So here, if the amount said $1,100, you would just pay $1,100, regardless of whether the supplier is GST registered. And from their perspective, it'll have this 10% amount, which they'll claim or ultimately have to remit as part of that process. From the perspective of the non-GST registered taxpayer who's outlaying that money, all of it is going to be a tax deduction. The tax office and the federal parliament recognise that food and drink, by and large, is of a private or domestic nature. And it's quite common for people to enjoy themselves going and having in social settings food and drink. By default, you can't claim a tax deduction on what they call entertainment expenses. Now, it's also a fact of business that from time to time you need to provide food or drink for your employees. And that is very much to the core of many businesses. And so the ATO actually use a multi-factor approach when they're trying to determine whether or not a particular provision of food or drink falls under the entertainment provisions, which are disallowed under 32-5, or whether they are not going to be entertainment related. And so the four things they look at are the purpose of the particular food and drink that's provided. So whether or not it's legitimately for the refreshment of your employees or whether it's just for them to enjoy themselves. They'll look at that factor. They'll look at the type of meal, so whether it's a morning or an afternoon tea and a light meal, or whether or not it's something more akin to a multi-course elaborate meal, which the whole purpose or process is to spend time to go through, have fun, and enjoy each of those components. They'll also look at the time. Again, it's not a determinative factor. Whether or not a particular provision of food and drink is done during work time or during work hours, or whether it's after hours in some sort of social function. That's less determinative than the first two. Also, the final point or final factor that they look at, which is where the particular provision is made, be it on-site as opposed to in a function room, hotel, cafe, or something similar. Again, that's not determinative either. The ATO look to the first two, the underlying purpose and the type of food that's or drink which is provided. That's really the bulk of the tests. The third and fourth factor that they looked at, while it is analysed as part of this process, are somewhat less important or less determinative. So for the purposes of advising clients, it's really important to note that ultimately, when they're weighing up whether to claim a deduction when providing food and drink, to just look at why they provided the food and drink. Was it ultimately to keep your employees, to make them happy, or was it to refresh them so they could continue working? If it's the former, unlikely that you're going to get a deduction. If it's the latter, you probably will. The next form of deduction which is disallowed are reimbursements. And look, this is pretty logical. If you've got some form of loss or outlay, and then you are paid to compensate that loss or outlay, you can't double dip. You can't still get the tax deduction because ultimately the net result is that you didn't pay for it. And so in a situation where an employer reimburses an employee for expenditure that the employee's incurred, that employee cannot deduct that particular amount. Now, the employer may or may not be able to deduct it themselves, but the key thing to note is that employees under Section 55 capital A, capital H of the old Act cannot deduct it themselves. One important aspect of claiming deductions under both the general and the specific deduction provisions is this process known as substantiation. It is the final step that the taxpayer must undertake in order to obtain a deduction. If you can't prove a particular loss or outgoing, you can't claim it. It's a pretty straightforward concept, really. Now, the way that you prove things is through written evidence. How you obtain that written evidence and the form that it takes varies for the different types of expenses that a taxpayer is claiming. And it's important to note from the outset that different types of taxpayers have different levels of substantiation requirements, with sophisticated large entities required to keep very, very detailed records, comprehensive records, whereas individual taxpayers and partnerships have less or somewhat diminished substantiation and record keeping requirements themselves. One thing to note about substantiation is that the invoice is at the heart of this process. So we hear the phrase, the informal phrase, tax receipts being used, but ultimately, putting our accounting hats on, these are invoices. They are a document which states functionally that a particular contractual arrangement is now in existence. A person is to pay, or possibly has already paid, an amount, and a service has been provided or is about to be provided, or goods are to be supplied. or have already been supplied, or a combination of those two. Ultimately, invoices are the key mechanism that you use to substantiate most expenses. Now, in situations where the invoice is lost, the taxpayer can still, in some circumstances, claim that particular amount. The requirements under the Act is that the taxpayer has to make an effort to try and obtain the original, or a copy of the original, to have that information. They can still claim the deduction after they've taken all reasonable steps. But as part of that, the taxpayer is going to have to take steps to recreate that particular pieces of information. And you can do that from secondary documents, bank statements and order forms and pricing guides and so on. It's probably a really good idea at this point to just map out what must go on a tax invoice. And so the three critical things are the name of the person issuing the invoice, the amount, and the date of that particular invoice. Now, ultimately, in most situations, you want much more information than this, but those are the ones that must be present. So if you are a taxpayer and you've received an invoice and it has those three things present, and it's fundamentally missing some other things, for example, the particular goods or services, or the delivery date, or the payment date, the recipient of the invoice, that taxpayer, can actually fill them the information in themselves as part of that. So it's important to note that the first three items must be on an invoice, otherwise it's not an invoice. It's not capable of being used by a taxpayer to substantiate a deduction. Also, and another important point to note is that if the invoice does not specify the supplier's ABN, the Australian business number, the taxpayer receiving the invoice, the person who's got to make the payment, must withhold an amount and pay that to the ATO instead. It's another important thing to note. So if you're in a situation where you have to draft an invoice, if you are the person selling goods and services, it is recommended that you put on your invoice that you're issuing your name, the amount of the supplies, the invoice date, the expected delivery date, the expected payment date, and the terms for those payments, so payment within 14 days, for example. You should map out exactly what the goods and or services are, and you should put your ABN on there also. So these are things that will make it functionally complete, so the recipient of that invoice will be able to claim the full tax benefit without taking any additional steps. Finally, there are some particular rules for employees. So people who derive salary or wage income can claim for deductions for things known as work expenses, which has a statutory definition in 900-30 of the new Act. And there are some specifically mapped out areas that employees can claim and particular rules. And for those that are going to be involved in sort of bread and butter tax advice to individuals, helping people who derive most of their income from wages and salaries, these rules you'll commit to your head and to your heart very, very quickly, because these rules and how these are managed and mapped out by the tax office are used by the vast majority of individual taxpayers. So a couple of things to note. First of all, there are specific rules for travel, car, union fees, and laundry. Those fall under the specific deduction provisions, and I won't elaborate on those here. Another rule is that individual items of $10 or less do not need the invoice. You can write your own document that can define or describe those amounts, provided that collectively they don't go beyond $200. Laundry expenses, that where a taxpayer has clothes other than the clothes that they would ordinarily wear on the street. So clothes, for example, for health and safety reasons, or clothes with a particular logo on them for the institution, will be able to be claimed in terms of laundry expenses. Usually it's $1 per wash. And you do not need to substantiate that if the amount of laundry expenses is $150 or less. And finally, we have the $300 no questions asked rule. And the tax office is quite big on reminding tax advisors and individuals that this does not mean you can always just claim $300 worth of work expenses each tax year. That's not strictly correct. The tax office can ask you to explain away your $300 or less work expenses, but ultimately, if you are claiming work expenses of $300 or less in total, and again, that would include laundry expenses, that would include items of $10 or less, that would include union fees and so on. If it's $300 or less, you do not need to substantiate at all. So you do not need to run around and have documents. But, and this is an important caveat here, if the ATO asks you, you need to be able to explain logically or functionally how you came about that figure. Tax agents and tax advisors, those that deal with the tax office, actually vary slightly in terms of how they go about interpreting that $300 or less non-substantiation rule. But ultimately, for those that are going to be advising individuals on their tax returns, that is a very, very important rule that you should commit to memory.